Welcome to our express video devoted to the subject of inventory. We are still within FA2 ACCA's paper Maintaining Financial Records, and this time we will talk about how to account for and measure the value of inventory. Let's look at the big picture first. If you recall from FA1 paper, the assumption for these exams is that when inventory is bought, it is debited to the purchases account and the credit obviously goes to cash or payables, depending on how the transaction is structured. Now, importantly, all the purchases go to a purchases account, which is technically speaking a P&L account. Now at the end of the year, obviously some of the goods was not sold, and whatever was not sold will be a balance sheet item, a statement of financial position item, and it has to be accounted for in this way. So all the purchases that we made during the year need to be adjusted by the bit that remains unsold at year end. However, at the very beginning, we had some opening inventory which presumably was sold during the year. In other words, what we need in our P&L as cost of sales is the opening inventory, because that presumably was sold, plus all the purchases made. Well, but of those purchases, something was left as closing inventory. And this is how we get to the number of items sold. If you still don't understand the concept, now think of it in the following way. Imagine a little girl who likes candies. And at the beginning of the year, she had 50 candies. During the year, she got 150 candies from her mom. However, what we're interested in, what we need for our hypothetical P&L, is the figure of how much she ate. And we will know that if we check how much she had at the end of the year. And if we know that at the end of the year she had 20, now she must have eaten all these and these minus what was left. So she must have eaten 180. And that is basically cost of sales. In practical terms, for accounting, we will do certain adjustments. Because as I said, the purchases were a P&L account, at the end of the day, so there is an end of year adjustment which transfers this to cost of sales. So at the end of the year, we will have credit purchases, and the debit will go here to cost of sales. But as I said, we also need to adjust the balance sheet items. So, well, we know that we had some inventory at the very beginning of the year. Now we will take it out of the balance sheet and the way we will do it is by debiting the cost of sales. Okay, we got rid of the opening balance of inventory. However, now we need to record the closing balance of inventory. If we put it on the statement of financial position, then the credit will go to cost of sales as closing inventory. Effectively, we will have opening inventory plus purchases minus closing inventory. Just what we wanted. There's just one more thing to say. Okay, we want to debit inventory in statement of financial position. How do we know what value to put on that inventory? Well, the standard says we should recognize inventory at cost. And cost is whatever we paid for that inventory, plus any irrecoverable taxes, like a irrecoverable sales tax or custom duties, and any costs of inwards delivery and any costs of conversion if we manufacture something. That will all be components of our cost. Now what happens if we trade with things where the identification of costs for individual items is difficult? Let's assume we trade with coal. And to collect that inventory of coal, there was 100 deliveries, and each at a different price. Then, obviously, we had some deliveries. In the meantime, we used some of that, and at the end of the year, we don't really know what we have in our inventory. We don't know whether what we have in our inventory is from delivery number 1 or delivery number 20. We don't know that. We need to take some assumptions here, and International Accounting Standard number 2 allows us to do it under two methods. The first one is first in, first out, so we will simply assume that what we use is what we bought first. Alright, so we first use the coal from the first delivery. When it's done, we go to the second delivery, and so on and so on. And then, effectively, what we're left with at the end of the year is the balance from the most recent deliveries. Average cost is an assumption that what we have in our inventory is just the average of all the deliveries we ever received. Now, the last important thing about valuing inventory is that actually the standard says you measure the inventory at the lower of cost and net realizable value. Net realizable value is the value we can expect to sell the inventory for minus the selling costs. So basically the net realizable value, because this is how much we will realize out of the inventory value. And if we expect that we would get less, so the NRV will be less than the cost of making it, then we need to reduce the cost or reduce the inventory value to that NRV. When could this happen? Well, this usually happens with damaged goods, with obsolete stock, obsolescence maybe due to legal changes or technological advancements. All these things may lead to us having to reduce the value of inventory.